Hey guys, great seeing you. Hello, Jan. Very, very happy to see you today. And I'm here with Oscar. And yeah, so we're super excited to be speaking with you. So Jan, maybe to kick things off, why don't you tell us a little bit about your personal background and what got you into running an institutional crypto fund?
Yeah, sure. Yeah. Hi, guys. Yeah, I originally studied, as you guys, business administration in my bachelor's and then studied data science afterwards. So I became a little bit more technical. And when I studied data science, I met a blockchain professor, Philip Sandner. And this guy, is really into these topics that we do at 21E6. And I wrote my master thesis about backtesting, about portfolio simulation, and topics like this with him as a supervisor. And then he approached me and asked if I would like to, make a startup about this and make a business out of this. And that's how it started. So at the end of 2020, we started with this business. We incorporated the company in 2021 and got other people on board as well in 2021. And that's how I to, came to be a crypto fund manager.
All right, yeah, thanks for that. Could you also tell us a little bit about what the fund actually does? And the second part of the question would be what your personal role is during these operations.
hmm Yeah, sure. Yeah, so 21E6 is an asset advisory company. We are based in Switzerland and we only cater to professional investors. We have three main pillars. So first of all, we have our flagship product, which is a fund of fund. And the fund of fund invests in crypto only funds. So we don't do Bitcoin trades and trades with other digital assets directly, but we invest in other funds and then they have all have different strategies that they execute. And the second pillar that we have is consulting. So we do advisory for companies, for asset managers that would like to get into the blockchain space and start investing in digital assets. And we come especially from the portfolio construction and risk management side in this consulting business. And then we have the third pillar, which is exchange traded products and other products that have crypto as underlying. But this is a branch that we will only set up sometime in the future. So right now we only have the fund of fund as an investable product, and soon other investable products will follow. And I am mainly in the fund of fund business, and I'm responsible for selecting crypto funds. So I do due diligence about funds and I talk to them. I read the documentation that they provide to us. And also we have to make sure that from the investment universe that we have, which is pretty big, there are about 1,000 crypto funds in the world, to select those that are really good. So I'm involved in this selection and due diligence process and also in the data management that is behind that.
And talking about the directional funds, I guess you had a look at 1,000 different funds in general. Can you tell us how many of them were directional and how many of them only do the net positive strategy, so to say? And do you have a particular technology that you focus on if you're talking about directional funds?
Yeah, to answer, I can actually answer this question quite exactly. I just need to find the correct slide where we have written this down. I think overall it's a little bit more than 50% that employ directional strategies. So just having a hodl strategy or having some other sort of directional strategy is the most straightforward thing to do, right? So it tends to be harder to find arbitrage funds and stablecoin lending funds and the like than finding the directional funds.
But from your perspective, do you think it's more interesting to actually look for arbitrage funds, or is it more attractive for your investors to invest into directional funds, or do you just want to have like a healthy mix out of both?
Yeah. Yes. So our strategy is to cater to investors that are very conservative and that have a relatively low risk tolerance when we are talking about a risk in the crypto space. So our investors expect us to have a risk profile that is similar to that of equities, meaning that drawdowns shouldn't be much higher than 30%. And we construct our portfolio in a way that we have about half of the funds in directional strategies and the other half of the funds in non-directional strategies. And with that mix, we get drawdowns that are in this ballpark. So we don't go below 30% drawdowns, or not worse than that. And the mix of both is what makes it interesting, right? So when the market goes up, we still want to participate in growing markets, but when market goes down, we also don't want investors that have just recently invested in our funds to experience 50% loss right away. So I would say it's the mix of both. We always try to reduce coin and ether exposure as much as we can in any case, because just by the nature of the business, we already have so much Bitcoin and ether exposure because usually most directional funds have some exposure either directly or through statistical correlation with Bitcoin and Ether, that it is always good for us when the investment universe of our target funds is a little bit further down the long end of the tail, long end of the smaller market cap tail, so to say. Yeah. So that's how we think about this.
And I guess if you try to cut out the Bitcoin and ETH exposure, or also like the correlation, that probably cuts out more than, I would guess, like 70-80% of all the funds that you look at. But talking about the other 20-30%, whatever, what are some aspects that you look at, and how do you evaluate the funds that you try to invest in?
Yeah, so that depends heavily on whether this fund is an arbitrage fund or a stablecoin lending fund, which are non-directional funds, or if it's a directional fund. So we have very different methodology for all of them. So for the non-directional funds, it tends to be a little bit easier and also easier to explain, especially because for the non-directional funds, as long as these quality criteria, these necessary criteria in terms of they have good custody, they have proper trading approval policies, the background checks are positive, and they don't have too much exposure to a particular stablecoin, and so on and so on. As long as these boxes are ticked, we can mainly look at the performance of these funds. And if they deliver month after month slightly positive returns without any significant drawdowns, then this is a good fund in the non-directional space. So that's relatively easy for us to make a decision for or against non-directional fund. When it comes to the directional funds, it's a little bit harder because proving that you are something special in this space by just buying certain assets and selling them again is a lot higher, and backtests are also a lot less reliable. So just because a fund has performed well in the past, that doesn't mean that it will perform well going forward. So there it's also a lot softer. So there we look at the particular strategy and we look at the team, see if they have the expertise to do a particular strategy. And at the end of the day, it is harder for us to really make a 100% call that we say, yeah, we are now confident to invest in these funds. So I always have a harder time to invest in directional funds. It also depends on, of course, there are many different strategies in the directional space as well. So there are long short futures strategies, which can be very systematic. So they often have trend following strategies. And when we see that the founders of these long short futures funds have worked in futures trading for commodities, for example, for a couple of decades before founding their crypto fund, then that is a good indication, for example. Or when we have a fund that invests in small tokens, when we know that these guys are really deep in the crypto network, if they're in all of the Discord channels and Telegram channels and everything, then this might also be a positive indicator. But as you can notice, it's very, yeah, it's a very, very gray, a lot of gray in this area, and very hard to judge.
Yeah, I mean, as you can tell in the bull market, everyone looks like a great investor. But
Yeah.
coming from a data science background, how long do you backtest for? Like, do you go years back and backtest for like the exposure the fund has at the moment, or do you backtest with the exposure they had in the past, if you're even able to access their like investment history?
Yeah, so yeah, first issue that you're already pointing to is we oftentimes, actually, we usually don't know the exact constituents of our funds. It's kind of the same also for our investors. So we also don't disclose our constituents, like all of our funds that we invest in. So, and the same is true for us when we invest in funds. So they don't give us a list, like panel statistics of how much exposure they had to particular assets at each point in time. We don't have that. So the only thing that we can do is we take the actual realized performance of the funds that we invest in and use this for backtesting. Because there is simply nothing else that we can really do. And we require at the very minimum 1 year of track record in any investment that we make, which is of course a lot too less to make reliable backtests. So usually we try to aim for 2 years, but in this space, of course, you also have to be quick sometimes. And if there is a promising manager that has performed well for 12 months, then we might also invest earlier. But just from the backtesting perspective, this is of course not 100% robust. Yeah? So we cannot rely only on the numbers when we make these decisions.
Okay, understood. And what would be also interesting for the viewer at this point, how long has your fund or fund product been around, and are you already able to like provide a track record, or is it still to be defined?
Yeah, from a pure quantitative perspective, yeah, probably also difficult. So we have started in April, at the end of April actually, 22, meaning that we only really have performance starting from May.
Perfect moment.
Yeah, May was then the month where Terra collapsed, right? But what has happened since then, at least, is I think we had minus 0.19 negative performance in May, which is quite good compared to, I think, minus 30 in broader digital asset markets, and a similar picture in June, where we were also down less than 1%. So it has worked out well for us so far. But of course, you cannot make a reliable, yeah, you cannot say anything reliable just looking at the numbers at this point. Of course, I'm very confident that our strategies work well, and compared with the overall market, they definitely did do well. But we need a little bit more track record so that I can also underline my assertion with actual data. Yeah.
Okay, but just looking from the fund perspective and the entire ecosystem and like the entire ecosystem's performance, it seems that you have done quite well. So that means you have somehow reacted to the sudden downturn after the Terra Luna collapse, right? What were your reactions, and how did you manage that entire scenario?
Yeah, two things. So first of all, the mentioned colleagues that have previously consulted for Swiss pension funds, they have developed risk models that are based on that look at the market stability of just overall markets and also of individual assets in a market. And these indicators are flashing very red at the moment and have already flashed red before, meaning that we had a negative indicator to not build too much exposure in the fund. So that means at the beginning we went into a couple of arbitrage funds, and we did not invest into any directional fund. By now we do have investments in 2 directional funds right now, but they constitute just about 20% of our assets under management right now. So we have about less than 20% of exposure in directional funds, which is still rather conservative. So that's the one aspect. And the second aspect is that we, from the very beginning, had a look at the stablecoin exposures of funds. And there was one fund that we shortlisted that was doing stablecoin lending. And this fund lost about 8% in May due to the USDT collapse. And fortunately, we were not invested in this particular in this particular fund. If a fund has more than 20% exposure to a particular stablecoin, that's a red flag for us. So if this happens again, we hope that we will only be marginally affected from an event like this. But of course, as we saw with Luna, there were also ripple effects throughout the whole ecosystem, and you can still get hit by this. So I'm not saying that we will not also have to face losses if something like this happens again, but we try to cover ourselves as much as we can.
Fair enough. Yeah, quite impressive.
Cool. Yeah. Thanks a lot for sharing that. So you also mentioned the two risk strategies that you're pursuing in terms of market exposure. Can you elaborate on what other risks you're taking into consideration when deciding whether to invest or not?
Yeah, sure. So especially in crypto markets, as you allude to, there are other risks than just the portfolio, like pure financial portfolio risks in terms of drawdowns and volatility. So we check how funds manage their custody. There are a couple of good professional service providers out there that can manage custody for funds. And this is especially important for arbitrage funds because they often have to move their assets quite quickly between exchanges. And that can be dangerous, and it can also be very inefficient because it might take time and be very expensive to move assets. So some providers have established, like Copper, for example, that our funds use, and we check which providers do they use, which trading approval policies do they have, who has access to the keys, do they use something like a walled garden. A walled garden means you have addresses with exchanges and possibly also a cold storage address, and you are only allowed to transfer between these addresses, and the funds can never go out of this so-called walled garden. So custody and approval is one big topic for us. Then, as I mentioned earlier, the stablecoin exposure is a big topic, and exposure to individual assets in general, and also counterparty exposure. So we always ask which exchanges are used and how much trading goes via each of those exchanges and how much money is kept at each individual exchange, because as we all know, not your keys, not your Bitcoin or not your crypto. Yeah, so if an exchange goes bust, we are not entirely sure what will happen to the crypto that is stored on these exchanges. So we also want to limit our exposure when any particular exchange goes down. And we actually also aggregate across our whole portfolio. We have an idea how much each of our fund is exposed to each individual exchange, and we roughly aggregate this to get a sense of the overall portfolio, of the overall exposure if one exchange should go down. Yeah. So these are the main points. Of course, also leverage. We check how much leverage funds take, but that's something straightforward, I guess.
Yeah, that's probably more part of the overall fund's strategy, right, which they've outlined.
Yeah.
Okay. So you also mentioned earlier that you're looking at the team very closely, and you also alluded to the fact that there's lots of new and upcoming fund managers that may not have as much of a track record that you would look for in a traditional finance fund, maybe. But can you elaborate on what kind of background checks you're doing on the founders of the fund?
Mm-hmm. Yeah, so oftentimes we actually know them already, or somebody from our team knows them or is introduced via a contact. So that's already, it's of course not sufficient to say that these people are trustworthy, but that's the first step. So we only rarely cold call funds, and from the funds that cold call us, usually we don't go very far in the processes. So we have already a good gate for the initial touch points. And yeah, the rest that follows is actually quite straightforward. So we do Google searches, we call them, we have calls with at least two people from the 2026 side. So we always have 4 I principal calls, and we roast them a little bit and check if they actually know what they are talking about. And we review the documents, the filing documents that they have, where they are incorporated, check the service providers that they use, the fund admins, for example. And then we get a good picture of the people that manage our funds. In the future, we might have to make this process even more sophisticated because, as I said, right now it was not our first priority because some of the funds are already well established and we knew those people before. But as we go into newer funds soon, we will probably also have to refine this process even more.
Okay, that makes sense. And are you doing any kind of hedging yourself, for instance, to offset this Bitcoin and Ethereum exposure that you were speaking of?
No, we don't do that, but it's definitely a good idea. So that's on our list. Yeah, we would like to do this meta hedging soon to just bring down the overall exposure to Bitcoin and Ether. But at the very earliest, we will do this at the beginning of next year. Yeah, right now there are a couple of futures that one could use to do that, but we have not found a suitable way of doing this right now. It's also a question of what your service providers can offer, actually. So if you have a fully regulated fund vehicle, you need a custodial bank that can perform this function for you, that can safeguard your assets. It's the same in crypto as also in traditional finance. If you want to make your fund investable to traditional investors. And that means we are constrained to what our financial service provider can do for us. And we are working together with them to develop their product offering so that they can offer the services that we need. But that's a constraint that we always have to deal with just because we are a strange mixture between the digital asset world and the traditional financial world. So it comes with some constraints.
And jumping in right here, would you say that your location, you're based in Switzerland, right, is an advantage or a disadvantage compared to other funds of funds worldwide?
Yeah, so the fund vehicle is in Liechtenstein. The advisor is in Switzerland. The fund vehicle where people actually invest in, this is incorporated in Liechtenstein. We also thought about Luxembourg. These were shortlisted by us, and Liechtenstein turned out to be our choice just because the coverage of financial service providers was best there. So the ones that we've talked to had a network there, and they knew that there is a bank that can perform these functions for us. So it was a pretty practical decision for us. We see a lot of funds in Cayman Islands and in British Virgin Islands as well. If you want to do direct crypto, if you want to trade crypto directly, these are probably the best locations to be in at the moment. So most of the funds that we invest in are in either of those two. And for us as a fund of fund, I would not say that Liechtenstein gives us any particular disadvantage or advantage. Liechtenstein has passporting to the EU, so we could distribute this fund, or people could buy this fund, to be exact, from many countries in Europe, which is very good. Regarding sales, it's a little bit more complicated. So we are not allowed to just go into every European country and actively promote our fund. That is a topic that is separate from that. You need to get the licenses separately. So if you're a fund that is maybe a little bit closer to Germany, it might be easier to also then promote this fund very openly. That is something I could think of. But apart from that, taxation perspective and all of these things, the big fund domiciles are all similar in that regard. Yeah.
Gotcha. Now that's actually a great lead into a different kind of, or a different aspect of your business. So we've talked a lot about the investing side of what you're doing, and what I'm also really curious about is your investors' perspective. So you already gave a few hints towards who these investors are, but can you maybe just give a brief summary of what the type of investor is that you maybe have today and what you're looking for going forward?
Yeah, so right now, our target group are family offices, high net worth individuals, and VC funds. We want to also get some pension funds on board, but these are the hardest ones to crack. So if we were able to get pension funds on board, then this would quickly open ourselves to a very, very large market. But asset managers that can totally decide themselves what they do with the money, so family offices, high net worth individuals, and VC funds, oftentimes pretty open to these kinds of investments, and we can talk to the founders directly, and it's just relatively easy to convince these types of investors just because they don't have regulatory constraints.
I think you didn't mention professional limited partners. Is that also something or a category of investor that you're interested in?
There are some funds that are structured as LPs, but this also differs between different domiciles. So some funds that we've invested in, I think, are structured as LPs. But that doesn't mean that it is like in Germany where you invest in a GmbH and Co. KG and then have to potentially go even to a notary, but the whole process is oftentimes easier in other jurisdictions. In Germany, we have seen this a number of times already that people set up a GmbH and Co. KG, so some sort of partnership, and then invite people to invest. So from a regulatory perspective, that's much easier oftentimes because you just have to set up this corporation and you don't need sophisticated fund administration and all of these things. So it's definitely a lot cheaper to set up a structure like this. If we invest in an LP, then they still need a fund admin. They still need professional NAV calculations, so net asset value calculations, and all that stuff. So for us, we are not happy to see this. At least not. It's not a good sign, but it's also not a red flag as long as they have professional administration.
Okay, understood. And now, why do funds choose to invest through you rather than going directly? I mean, there's obviously this point of double management and performance fees, but I'm sure that these investors that you're dealing with, they have their reasons for why they're picking you.
Yeah, hopefully. So, yeah, first of all, if one would want to try to select funds themselves, if an investor would try to do the work that we did themselves, they would need a couple employees doing this and would need to first identify about 1,000 funds that there are worldwide, then talk to many of those funds and get down to, let's say, 20 of them, which takes a long time. Yeah? So time to market is long and it's also very expensive to pay people with appropriate knowledge to do that. Then the second reason is that we have more leverage when we talk to these investors. We often get better deals. So we do have this two-tier cost structure, but one of those tiers is getting a little bit cheaper. Yeah? So we get better rates than our investors would get just because of the amount that we can invest. And third point is in many funds, you cannot invest if you don't invest at least 500,000. Usually the minimum is 100,000 US dollars. But then the problem is, even if a fund has a relatively low investment minimum of 100,000, which is the lowest that we usually see, then you have only invested into one single fund and you have zero diversification at this point. So in order to get a diversified portfolio, which you could get by investing also a minimum of 100,000 in our fund, is not possible otherwise. Yeah? So many of these family offices don't want to invest, let's say 10% right away into crypto, but maybe just want to invest 2%, and then they might only have, let's say, 1 million or something. And it's very hard to build a diversified portfolio in crypto funds with this kind of money.
That's probably a question that you get asked very often about this double fee structure, but obviously like your product are funds, not crypto itself, right? because you're diversifying by investing in funds. And I guess just by looking at your asset under management, you've proven that there's a product market fit for your funds of fund product. And yeah, just wrapping this up, is there anything, like any skills, any learnings that you've taken and applied to your own investment strategy? So to your personal investment strategy, are you invested into crypto, or is it with your work? Is it enough?
So I was invested already before, but I did not really learn much for my personal investments, I have to say. So the sophistication of my own strategies has not grown since working on a professionally managed fund. I'm still only hodling, so I'm just long in the big crypto assets. And I'm also invested in the fund, which is probably the best managed investment that I have in crypto. But the things that I manage myself, I don't take as much care as I take for the fund.
Fair enough. And looking at the macro market right now, how do you see the market performing within the next 12 months? Are you guys gonna go into new funds, or are you gonna stay mostly out of the market, or just in arbitrage funds? And what is your strategy there? And yeah, just looking at the entire macro picture, it looks difficult at the moment, and it would be interesting to see it from like what the professional side of the crypto do at the moment.
So we slowly build exposure in directional funds. Right now we have less than 20% of exposure, and we gradually build up. We also don't want to get left behind and be at a situation where the market goes up and we did not act, but we are still rather cautious. So the target allocation, long-term target of about half, about 50%, is still a long way to go for us. But we continue to look at new funds, and we continue to increase exposure. So overall, we are bullish. Otherwise, we would probably not be in this industry at all. But we try to, even if we are wrong, not have too high drawdowns. So even if things go further south, which nobody can really tell, we want to offer our investors still acceptable losses, so to say. So as we have shown in the last month, even if markets go very bad, we can still perform okay and preserve capital for our investors. It will be interesting to see if there are a lot of different trades in arbitrage that one can do, and what has not worked so well already before May was the basis trade in futures strategies, where one sells future and buys the spot asset. Used to work very well in crypto, and it's just an arbitrage trade, right? So it's basically a risk-free trade from the market exposure perspective. And this one has not worked very well starting in November 2021, and we will be interesting to see if this is going to pick up again, and then potentially allocate more money in arbitrage funds that focus on these strategies. So that's one thing that I'm having a look at right now.
Maybe one final question from my side. The indicators that were flashing red that you were mentioning in the beginning, what kind of indicators are those, and are you looking at them at the moment? Are they flashing red, or is there maybe a little bit more hope for the market to go up again?
Last time I checked, it was 2 weeks ago. We run these checks every week, but a colleague is doing this. So my colleague Tobias is doing this. He wrote his PhD thesis about this topic, and these indicators indicate if the market is stable or not. So if deviations in price action are stronger than usual, then the indicators start flashing red. So in a sense, these indicators are always a little bit backward looking, or they are by definition backward looking. So it's not like you can anticipate really what is going to happen, but it's more like a method of nowcasting. So knowing in what type of market regime one is in, and usually markets are trending, especially in crypto markets, meaning that if you're in a market regime that is unstable, this market regime tends to persist. So the assumption of these models is that there is a certain persistence and inertia in market trends, and this is what we can use to just identify that we are in a bad market situation. We might not really be able to anticipate them, but we can at least get out before it gets even worse.
Yeah, I mean that makes sense, right? And that is probably also why the smart money outperforms the holding strategy that you're doing in your private investing, but where you might also not have the time to like over engineer, right? So yeah, excited to see what's coming. Yeah. Arne, do you have any further questions to Jan?
No, not from my side. Thanks a lot for taking these questions. A super interesting conversation. I mean, we've obviously talked off the record about this quite a bit already, but every time there's something new in it. So really appreciate you taking the time to take us through it one more time and also making this stuff public. Good luck going forward. Hope for all the best.
Thank you very much. All right.
Yeah, thank you also from my side, and thanks for your time.
Thank you.
Enjoy your evening.
You as well. Bye-bye.
Bye.